if we are still waiting for people to stream in, as usual with our seminars / webinars, I always ask the early birds, if they've got any kind of like questions regarding the markets, maybe you can tackle some of them here first. This is like a little bit of a bonus for people that come in slightly earlier. If you have any, you can like just type it on the comments portion and I'll try to tackle it. Maybe we'll do it for another 3-5 minutes before the rest of the crowd come in. Okay, don't mind, I have to like flip over to the other side because this is where I see the questions. Hey, Charlie. This question, your views on the China correction. I'll take that a little bit more later on, but then in general, I feel that, this has really taken the market by surprise. There's been a massive fall. I mean, if you have not been reading our markets, China is a bit of a closed market, but then a lot of people are looking at Hang Seng as a conduit, and you can see the Hang Seng index free falling 15, 20% by now, and this is because of the government's actions, and first against the tech guys, and then following which there was the education hit. Now the regulators seem to be all out looking and then having their knife sharpened against the tech giants. So at this juncture, I think that there is going to be a little bit of uncertainty, and the worst type. Okay, other than the unknowns, like what happened during COVID, right? But then the worst type of like major factor that can affect the markets will be regulations and regulatory actions. In this sense, China, a lot of things we cannot really guess what they are trying to do. We can't double guess. It has nothing to do with the fundamentals of the companies. Of course, if you look at fundamentals, many of the companies now look very, very cheap. But then if there are further actions that could actually like hit the companies further. Okay, 2:35, we can start right now. Okay, organizer said that we can start right now. Julian, we're good to go, right? Okay, I'm gonna start to do sharing screen. The rest of the questions, we'll take it a little bit later. Let me go ahead to share my screen first. Okay, welcome everybody once again to the SIAS webinar. It's been quite a long time. I think the last time round I did it was in last October, and last year, towards the end of last year, I was still very, very hopeful that, hey, maybe for this year we can possibly go out there and meet you in person to do a seminar. I've not done one since November 2019, and I think the last one I did was with SIAS. It was one of the Money Mind programs, not Money Mind programs, it was one of those Money Sense programs, and that was just before my 2019 year-end holidays. I still remember vividly, just 2-3 days before that. And then shortly after, during Chinese New Year period in 2020, COVID hit. And we've been holed in since then, and we've been doing webinars. Not my preferred choice, like I like to see you guys face to face, get you all to ask questions, during seminars, and sometimes you are sleeping, wake you all up. But I can't do that for now. This is really the next best option. Today I'm gonna talk I'm gonna look into the future, and I'm gonna like talk about how you can profit from the future. This is a very, very big topic because future can mean short term, like what the market is going to be like in the next 1 to 2 quarters. It can also mean some mega trend that's happening. This is an area, these 2 areas are things that I want to concentrate on. And incidentally, we actually launched our website. It was not planned this way. We launched our revamped website, the www.azure-capital.com.sg, which you can see here. You can click into it. And the key theme that I have is really profiting from the future. Over the last 1.5 to 2 years, I've actually sort of swerve the direction more towards looking not only equity, but we also look at debt and other kind of macro instruments. But all of them have a common DNA. These are future-proof products. These are future-proof investments, and that will be able to not only survive but thrive. 1.5 years ago, there was no COVID. But we already we could tell that there's going to be this bigger trend that's happening, and COVID just basically accelerated that trend. But before I go on to the big picture, I'd like to talk about what we want to know most, which is the Singapore market. Okay, Singapore market. This is just a quick This is just a quick flash on the Singapore market. We are up 11%. This year, which doesn't seem like it's a lot compared to the US markets. S&P 500 is up 16%. Dow Jones, after a strong the last 3 quarters of the year in which it bounced up 20-30%, it's flat. But Nasdaq itself, the tech stocks, it has been running ahead and it's also up 15%. But while it does not look impressive compared to the US markets, if you compare it against the Asia Pacific ones, Singapore, surprise, for this year, we are actually one of the top performers. In fact, I think it was like in April or May, we were the top performer in Asia Pacific with 11.8% returns, and this far outstrips some of our traditional rivals, like the Indonesian exchange, the Thai exchange, Hang Seng, right? And all these were actually lagging behind STI. And it's surprising because Singapore was seen to be a very, very slow market. It's going to be a perennial lagger. I think the last time round where we saw life was in 2017. But why did we actually pop up? It is the very reason why we are deemed to be a slow market, because we are if you look at the STI, it is very, very value driven. There are many value stocks. And last year, unfortunately, it was not the year of the value stocks. People wanted sexy. People wanted technology. People wanted growth. And hence, because the STI, if you look at the component stocks there's none. Maybe one, venture. The rest of them, out of the 30 stocks, maybe 15 of them are dividend yielding stocks, high dividend yielding stocks. We have the banks, we have the telcos, the REITs, of course. And the worrying thing is that after the 30 stocks, the next 5 on the reserve list, they were all also dividend yielding stocks. So it was very value heavy for the STI. And last year, like I said, they didn't like it. But this year, there was a rotation to value. And hence, one of the top markets that investors in the region looked at was Singapore. And if you look at the performance of the various counters or the various sectors that you have here, all of them were relatively weak last year, save for healthcare. I'm not sure whether you can see it. Right at the end, healthcare saw a big pop. We're talking about 94.8% on average for healthcare. All this data is we garnered it from SGX, so I believe it's right. Except the composition, we're not very sure what was the composition. And this is the 94.8% was really out of the world, but you don't see it in the STI because these guys are not STI constituents. So the doubling, where they come from? Glove makers. Many of them were upwards 6 to 10 times. Think Top Glove, Riverstone, as well as UG Healthcare, right? And then there was MedTech. MedTech went crazy. I think it was 20 times. So all these things dragged or actually pulled up the performance of the healthcare portion. The rest of them, like I say, is underwater. Last year though, oil and gas from SGS, this is something that I'm a little bit curious about. It was said it was up 30% the first half of this year. I'm going to try to see what's the composition. Perhaps there's 1 or 2 of these guys that saw some privatization. I don't know, it's up 30%. But this year, the tables have been turned. What we saw as the best performer, which is the healthcare division, right now is languishing versus the rest of the index. Particularly the oil and gas. Oil and gas is up like 60%. And unsurprising, because you look at the oil prices. From negative in April last year, it popped back up to $70, $80. Now people are talking about oil 100 again. It was unimaginable last April when I say it was negative. In fact, it was unimaginable at the start of this year. But yet, we are so close, or we are just almost a whisker away from seeing that oil at $100 per barrel again. The rest of them, like I said, have done fairly well. And if you look at the index itself, index versus the index of the region, this again perennially we are not expensive. We are talking about 12 to 14 times this year and next year's earnings. Price to book only about 1 time. If you compare against our rivals in the region, they're trading anywhere between, we're talking about Southeast Asia, anywhere between 1.5 times for KLCI, all the way up to, say, 2 times for Jakarta. Only Hang Seng Index is slightly lower at 1.2, but still more expensive than it is for the STI. Some of the reasons why we are actually like seeing some of these external some of the factors why we are looking at a very conducive market in the first half of this year. External developments definitely play a part. The small open economy, so anything that happens overseas, particularly in the G3 as well as China, have implications for Singapore. And it so happened that US market, being the front runner, has been extremely strong. It is a great bellwether, and so we also have been riding on that. If you look at Temasek, there's been some major shakeups. I'm not saying that really contributed to the uplift of the market, but it has somewhat of an impact. There's a push, a very, very evident push that happened, started last to like shake up its babies, reinventing itself and making it a lot more streamlined. One of the last year you saw the demerger between Sembcorp Industries and Sembcorp Marine. Industries shareholders were happy, not for Marine. And Marine is very sweet. It's like double whammy. This year also kinda. SIA, last year, Temasek needed to bring it into ICU and then start to resuscitate it. It did it successfully. Another round this year. DBS also went through some form of restructuring. This year, Temasek continues to be very active. First up was CapitaLand back in March, and CapitaLand, the move I thought was quite astute. It was I think the way it's restructured it was very, very beneficial for shareholders. I can talk a little bit about it later on. And then came the Keppel Sembcorp Marine deal. This deal has been in talks almost forever. For as long as I have been in the industry, which is about 21 years, I've been hearing about Keppel and Sembcorp Marine possibly putting itself together. And then there were, of course, urban legends saying that, Sembcorp Marine shareholders will be the beneficiary because it's going to be injected into Keppel, because Keppel, being the Taikor, it has a bigger footprint at that point in time, right? But not so. There was a big surprise. It's going to be put into a combined entity. Keppel shareholders will get paid out because Sembcorp Marine, after another round of restructuring by Temasek, there'll be another injection, another rights issue, which is highly dilutive. Shareholders for Sembcorp Marine, I'm sorry, because you either have to take the rights, or you'll be heavily diluted. And I think that they probably have the short end of the stick as compared to Keppel shareholders. And now there's a lot of people talking about, a possibility. I don't think that Temasek will stop here. there's still going to be some work that's done, even though I think a lot of the big heavy lifting has already been completed. So what's next? Perhaps SIA Engineering, ST Engineering coming together. I think there's a typo here, like two N's. And furthermore, I think that there's going to be more that's happening on the local front. If you look at the vaccination, a lot of it, we are talking about moving past COVID. And how do we move past COVID? That's generally vaccinations, right? This is recognized globally. That's something that we have to do. Currently, it stands about, I think as of yesterday, was what, 53, 54%. The target is 2/3 of the population by National Day. That's really a big jump. I think we only started having the vaccines in February this year. Already we're talking about 67% of our population by National Day. Of course, this year we have 2 National Days, right? With the National Day or the National Day Parade. By National Day Parade, I think we pop up beyond 70% already. And by September, we're looking at 80%. We will be one of the most vaccinated countries globally. And that really will move towards some form of normalcy. We'll be welcoming tourists again. People can travel out the country. We can go have meals outside, more than 2 persons, right? So there's many restrictions will be lifted by then. I think that the reopening place will once again be in play. And that's why during this particular phase 2 HA part 2 that's happening right now, there's not a major sell down or knee jerk for some of the reopening plays. We know it's going to be kicked down. The can is kicked down, the road, the path, but it is not so far away because as you can see, the vaccinations growing, we are closer and closer to partially opening the doors. And other factors that support the local market, we see the banks, which are a big part of the STI, that record earnings in first quarter for the banks. If you look at DBS, that's stupendous. It's like $2 billion, right? And this very, very strong set of results have actually propelled the STI up also. And the private home sales, we are also very heavily very heavily dependent on property developers. And the strong home sales, I think, were also buoyed sentiments within the STI. So what's ahead? Somebody just asked me regarding the China-Hong Kong situation. It is bad. It looks all red. I mean, every day people are waking up, they'll just go, how low can it go today, right? And but we do, the positive thing is that we do see some retail guys, I mean, in China, trying to come back into the market. It's just that at this stage, at least for international investors, if we do have outside opportunities, we don't have to fight against the tidal wave. I'm sure there are value plays there. Many of them are multi-year lows. Some of them have even gone below the COVID, when it was darkest point of COVID, which was in March last year, and they've dug below that. So it does look very enticing. And this morning I heard on radio, one commentator, one international investor was saying that this is probably, the opportunity of the generation. I have no doubts it's cheap. But then, like I say again, that you are really fighting with big tidal wave that's slamming in front of you. You just don't know how big it is behind, right? I mean, if you can see it, it's 2 meters, like little mini tsunami, you can tahan, right, if you have a house. But if it was way bigger and you don't know what's behind it, that I think is the danger of investing when at this juncture, because a lot also depends on the regulators. Of course, it's great if the regulators are back. They want to protect the retail investors who are already very, very much invested in the market. Then they send the so-called national team and start to prop up or at least protect the market from further downside, while trying to whack the tech giants, while trying to whack the ride-hailing services, trying to whack the education guys, right? So there's a lot of things that's happening right now. I see some of the, over the weekend when they said that they were gonna cancel out private tutors, or not the private tuition centers, and that I thought would have a major impact, because if anything, like Singapore, like South Korea, in China, that is a growing business and it's growing tremendously. And to actually plug it out of the system, I thought that was quite a drastic move. So there's still a lot of uncertainties when it comes to especially the regulators in China. So I would take a more cautious stance, while recognizing that many of these guys are cheap. And if you look ahead, I think that, as I mentioned earlier on, there's going to be increase in vaccination, 80% by September, and perhaps we move towards 80+%. I'm not too sure whether we can break 90% anytime soon, because there are people that are resistant of the against the vaccines, right? So unless the law comes out hard. So now we are adopting a stick and carrot approach. In future, people that are vaccinated can actually go out to shop, can go travel, come back. They don't need to be quarantined. So there are efforts to actually like increase the vaccination rates. Currently, and we are also very dependent on technology companies manufacturing, and the current semiconductor shortage may have an impact on a near-term impact on the tech stocks, but this is something that we have to take a closer look at. I can discuss a little bit more about some of your favorite technology stocks a little bit later. Some sector highlights. One of the most spoken about sectors will be the banks. If you look at the US banks right now, one of the big things is that they are reversing the provisions. And we're talking about even they have already reversed between 40 and 45% of the provisions. As this economy starts to take shape, you can see it's getting stronger. The demand for jobs have jobs have increased, and you can see the unemployment rate actually plummeting significantly. That has taken me by surprise. At one point in time, we were talking about 13% growing to 20% unemployment. Right now, we are in a very tight situation. Obviously, and of course, these guys are not being paid the same way they were paid pre-COVID, but they are employed, right? So the economy is on a strong footing in the US, and if the Singapore banks do likewise, we're talking about 40-45% provisions. We are aiming at this could potentially boost the earnings by another 10-20%. The NIMs have also stabilized for the banks. And in another good news, I had to change this slide a little bit because I was saying that MAS could possibly lift the dividend restrictions on banks just a couple of days ago. And yesterday, MAS said that they will lift the dividend restrictions on banks, even though they had a caveat. They were saying that, we are not totally out of the woods yet. So you still have to be very, very careful, but you don't have to abide by the restrictions that we had before. So the bank share prices have gone up tremendously over this period, talking about 14-20% on the lower end as UOB, on the higher end as DBS. They're trading at 1.1 time for UOB and about 1.3, 1.4 times for DBS. Again, you can see that investors are generally a little bit more cautious about UOB because of its exposure in ASEAN, and they are more optimistic of DBS. And if you look at the yields, which is one of the big draws of the banks, and despite them going up about 14-20%, we're still talking about very, very decent 3.6 to 4.6% yields for this year for the banks. REITs, another very popular sector. You can see the subsectors have the performance of the subsectors. Industrial, healthcare, taking the lead, unsurprisingly. Hospitality, it is still lagging behind because we have not completely opened up the hotels. The occupancy rate is still anywhere between 50 and 55%. I think with the reopening, that should easily bump it up by another 10 to 15 percentage points. This will be positive for hospitality. REITs, a little bit more muted for office, also because I think of the work from home. And I think moving into the next few months or a couple of years, there will be big companies, the banks, the financial institutions, actually giving up space because they realize that they don't need these sprawling office spaces anymore, right? Many people have opted to work from home. In fact, a recent survey that was done says a majority of them say they like the current arrangement, which was unthinkable, which unfathomable, say pre-COVID. At a point in time, the employers wouldn't even think about it. There were options and opportunities for work from home, but I think it was very, very small. It's like maybe 5% of the entire workforce. Right now, more than 50% say they can work from home. And this, I think, will change the dynamics of office space in the CBD, the Grade A office space. Fortunately for them, the tech companies, the global tech companies and the China ones, they're also expanding very, very rapidly over in Singapore. They're using it as a global or regional HQ. And this is positive. This will be positive for office space. But net, I think that there will be the people that will be throwing out and giving back their spaces would outstrip the demand that's going to come in. So the office landlords will probably need to rethink their strategy about what they want to do or how they can go about enticing and drawing new tenants. The industrial REITs, they've been most aggressive in raising new equity or perps over the past 12 months. 60% of the total $7.6 billion raised to fund acquisitions came from the industrial REITs. And the DPU uplift has not really been fully factored into the estimates. As I mentioned earlier on, I think hospitality, tourism REITs, those will be chief beneficiaries of the reopening. Just need to hang on and wait for the day or the period to come where there's going to be opening. And not only the hospitality tourism side, not only the hospitality, but also in terms of airlines. And therefore, when Finance Minister Lawrence Wong a few days ago was talking about the possibility of reopening the borders, the first to pop up were the hospitality place and SIA and SIA's babies like SIA Engineering and SETS. Property, one again, being traditional investors, and the STI is very, very property heavy. The good news is that there's been hefty transactions over the past year. In fact, COVID time, just after the circuit breaker, it happened just after circuit breaker. I remember in June, people were really hungry and going out in droves. It's like money is free, I know money is cheap right now, but then they act as if money was free. So there's been a lot of people, there have been a lot of transactions, people coming in to buy, and the stock has been depleting over time. The new private home sales in the first half of 2021, 6,600 units. That's already 65% of the total in 2020. And if you look at the resale, that's 9,100, 85% of 2020's total. Last year, the private home sales, first half versus first half, I think it's up over 60%. HDB transaction volume also continues to be high. I understand a lot of them, once they put up to the market, it's been snapped up, especially those prime HDB properties. If you look at the big three within the property space, CapitaLand, UOL, City Development, they are trading at a huge discount to the RNAV. CapitaLand, the discount is the smallest. I think it's about 30%, slightly less than 40% discount to RNAV. That's because of the recent restructuring effort, right? Before that, without it, it would have been half, 50%. That's where UOL currently stands, about 45 to 50% discount. The biggest discount is about 58, 59%. That's CDL. And CDL, it's not because of its business here. It is more because of it is all to do with its investment, the done investment in China relating to Sincere. So there's a big range between 40 and 60% discount to RNAV. Even if you take the cheapest, which is CapitaLand, it still seems attractive. But traditionally, I think for the discount to RNAV, there's always this discount, but the discount is now quite wide when it comes to the big three. CapitaLand's restructuring effort actually encompasses it, taking out what I feel is the unsexy part. Actually, not only me, but I think any investors in general would believe that, this is the very unsexy portion, which is the development part, because that involves a lot of money and the gestation is very, very long, right? It takes years. And that is why there's a big discount. So they strip that out and they continue to have the real estate investment management business. So that business, if you compare against other real estate investment managers, say in Australia, like Landlease and the likes of it, they're trading about 2 times book. Whereas these guys are going to be injected in, I think, just over 1 time book value. So it is, I think, to the benefit of shareholders. They'll be getting back dividends for this year. They'll be getting back not only dividends, but also shares in CI, the capital in the integrated trust. So all in, that has boosted the share price. I remember when they made the announcement, CapitaLand was at $3.31, and currently, as of yesterday, it was at 4.3. So there's a big jump. The theoretical the theoretical price that CapitaLand came out with is 4.102. So it's very, very close. It's maybe about 2% away from what is the theoretical price for the sum of the parts. Tech stocks. Tech stock share prices have went through a roller coaster. It went down and then it rebounded back since June. I think that there are a lot of tech is a wide area. I started out as a tech analyst, and even then I couldn't grapple with all the different parts of tech. You got to be follow it very, very closely. And there's like 5G adaptation. At point in time when I started, there was no 5G. I think it was not even 3G, right? So now it's 5G adaptation, IoTs, electric vehicles. That's another hot thing, regionally and globally, servers and computers. And if you look at the semicon demand, that has really, really been very strong. But our tech companies are not the out and out tech companies, the innovators and all. Most of them are actually manufacturers. So when you come to manufacturers, of course, you don't get the kind of high valuation like the 30, 40 times that some of the tech companies in the US or North Asia would actually garner. But we hang around the 13, 14 times, which I think is reasonable. It's not the cheapest level. Many of them used to trade at between 7 and 10 times. Now it's 13 to 14 times, given that there's a lot of investments that's being driving in. Like I said, the likes of AEM, Franken, and UMS, they have like seen favor with investors because I think not only is business doing well, they also have a very, very strong balance sheet that can support decent dividends for tech companies. Many of these tech companies used to garner dividend yield of 5-6% easily because they continue to dish out. They get cash, they dish it out to investors, they keep some cash of their own, and the balance sheet start to grow, right? The likes of venture is a good example. Not promoting it right now, but at one point it was trading at 6 to 7% dividend, given that it has consistently been giving out like 50, 55, 60 cents per share of dividends. But that, because of the share price improvement right now, I think it is going at about 4%. But all the tech issues that you have to be very, very aware of will be the supply side. There's a chip shortage since December, and this has continued on. This has created a strain on the production for the companies. And I understand that many of these manufacturers are actually going out and saying that, hey, if you want your chips fast, you have to pay a premium, which is understandable at this juncture. So with tech, I want to move on to looking into the future. Tech is a very, very important part of the future, and there are many ways of actually investing in technology. What has happened, I think, is that most companies currently are being disrupted. I had a long discussion with one of the most renowned investors in Singapore, and he was lamenting, for the longest time, he has been very resistant to change. A little bit like Warren Buffett. Warren Buffett used to say that he doesn't understand tech, so he don't invest, but now he has like changed sides. So for this investor, he was saying that, I want to invest in those guys that are trading at 3 times PE. They are in traditional industries that will definitely be around for a long time, right? Construction, animal feeds, or those things involved with livestock. But even that, he said, is being disrupted by younger startups. So he has seen firsthand, and he has like changed his impression of it. So disruption, I believe, is a given. And I look at right now, for me, if I were to look into investments, whether it's in the stock market, in the startup space, there must be a plan to actually make it future-proof. And it is very, very important. That is why it's something that I highlight in my revamped website. This was how we have been positioning it for the last 1.5 to 2 years, that we need companies to think about solutions that will allow them to actually thrive in the future and to be around for, for generations. Many of these guys, they have been around for generations, but within the last few years, they find themselves obsolete. They are no longer important in the grander scheme of things, and taken up by and being eaten up by companies that were barely started a few years ago. So I think the best companies, are really those companies that can address a very, very big pain point and be able to scale, not only regionally, but globally. One of the examples, and I want to show it to you through an example, a real life example that I have. It's one of the funds that I run. But again, this is not a way to push this fund, because I can only serve the accredited investors. I believe we have a big group of investors right here today that may or may not be accredited. But I just want to show you a case in point that some companies are there, and it can actually improve on the way that we live, the way that we work, and yet provide good, sustainable returns in a very, very safe manner. This fund I've already mentioned previously, and you can see it across the media. This is Azure-Lyte Fund. We're talking about future of work. What's the future of work? Future of work, I think, before COVID, many people were really, chopping stuff because they feel that robots can do it faster. They can be more productive with AI tools. But the COVID situation actually accelerated the whole situation. There will be people that will be unemployed. And when they are unemployed, they may be forced to be freelancers. Used to be the freelancers like real estate agents and insurance agents, they were by choice. But many of them, I think, in the next, currently and into the next few years, there'll be a growing pool of freelancers. And based on different reports, we're talking about maybe 20 to 30% of the population may be freelancers in the not too distant future. As I mentioned, it can come in the form of real estate, insurance agents. It could be, doing IT. There's this freelancer website also, and influencers. One of the big pain points for freelancers will be commissions. Commissions, they are paid generally, like say when you're a real estate agent, you sell an apartment, you sell a new apartment. It takes you anywhere between 6 and 9 months before you collect commissions, after the job is completed, right? So people will be there waiting for the money. They're not salaried employees. But we have created a system right here with my partner Light that will be able to address this pain point. We can actually pay the commissions faster than that, right? We can pay it when you want it, when it becomes safe for us. And we don't sign on with the we don't sign on with the individual freelancer, the real estate agents. We sign on with the agencies. And I think that that's a very, very powerful thing, because the agencies will be our legal counterparty. If the developers don't pay the agency, the agencies will have to pay us. The beauty about this is that we have ring-fenced all known risk. I cannot say that all the risk, because there could be some unknown unknowns, right? All known risk, we have made it safe. The default rate is 0%, but yet we offer solid use of 6 to 8%. This project is also backed by quite a number of reputable individuals, as well as family offices. So the exclusive service agreements that we have are with the 6 largest property agencies in Singapore: ERA, Propnex, Huttons, Orange Tea, SRI, Knight Frank. They account for 95% of the total commissions payable. And I think that this is powerful. We basically have data from across the industry, amongst all the practically all the major agencies. Not only that, we're also like advancing with to the likes of Gush Club, which is the largest influencer agency in the region. They have about 15,000 influencers, and these influencers actually paid very, very well. If you look at the boy that opens toys, unboxes toys, he gets paid $20 over million, right? Of course, in this region, we don't have all these outliers, but even the top 100 may earn $300,000-400,000. The problem is the same pain point as the real estate agents. They get paid 2-3 months away. Many of these millennials who want to be paid yesterday for the job that's done today, right? So after they've completed the job, we make sure that the invoice is with a Fortune 500 company, we advance it. Samsung, we're also working with them right now. So there are a lot of opportunities. This is something that we'll be able to scale both regionally and globally, consequently, and we already have a game plan for that. You can see explosive growth, 57% quarter-on-quarter growth over the last 4 quarters of continuing to actually give advancing their commissions. This is important, and this 57% is important figure because it's only one agency. I've got exclusive with 6 agencies, so there's another 5 big ones to go. We just rolled a Propnex, which is also very, very successful. The take-up rate has been extremely strong, and this is one of the projects that I'm very proud to have be associated with. There's a few notable investors like Eric Low from Oxley, Koh Pong Hui, Tan Chin Hui, who's the CEO of Trafigura, Lu, he's Singtel's Digital's boss. Singtel's also invested in this project. Aaron Tan, he's from Caro. Caro, if you recall, recently it was the most recent unicorn, having had investment from SoftBank. So there are many notable investors in this particular project, and I think that I've put it together in a fund. The fund dishes out 6 to 8%, very, very safe. Like I said, I cannot sell it to you guys. I can open it to many of you, but I do want to make this, eventually I hope to make this a retail product so that everybody will get to enjoy this. I think that, with the risk, I feel that the risk is very, very small. In fact, it's the only investment that actually talked to my grandmother about. So that is Azure-Lyte Fund. We talk about the stock market. Again, this time round, just for SIAS members, we are offering a complimentary review of your portfolio. We're limiting it to 3 investors like last time around. Last time around, I think we limited it to 3, but then we upsized it by a couple more because of the very, very strong demand. What we realized over the exercise was that David is helping me, my colleague David is helping me with this. Some people that they sent in, we only want to look at some of the, I think some of the cases where, it's quite extreme. We've got this guy with 90 stocks on the portfolio, and we had to clean up, the maybe 70-80% of it. And consequently, what we did was to sort of rejig it and tell him that, since you're not paying attention on the stocks, you must well, do the lazy way. We can put it into index and all, and we recommend them that we don't sell them. But then this is a complimentary service because, like I always say, I'm very, very indebted to SIAS. I grew up with SIAS professionally. So this is something, pro bono service that I provide for the members. I hope it benefits them. But the thing is, I can only service again with apologies because my license only allows me to do accredited investors. If you believe that you're accredited investors, you just need to go to the MAS website or you just type in accredited investors Singapore. They will tell you what are the criteria. You know, there's only two main criteria. One is income if you are not working. Another one is the net worth criteria. So if you fall under accredited investors and you think that, you know, you require some form of help, personal servicing will get you to come down. Maybe not now because it's heightened alert, but then when it's safe to do so, or we can do it via Zoom, we will get you to come over. We will have a communication with you to tell you, hey, this is your portfolio. We will try to break it down in terms of, you know, asking questions, pointed questions like, do you have an investment strategy? Do you want dividends? And we look at your expected returns and your current portfolio, whether there's going to be a discrepancy between the two. What is the volatility? We break it down into numbers for you, and then sometimes it could be surprising. You want a certain return, but your risk is not, your tolerance for risk is not there at all. So we'll tell you, hey, you got to balance it out a little bit, right? And we'll take a hard look at your stocks. Many of them, if you do have a big bag of stocks, chances are we'll ask you to dispose of some. So you need to like bite the bullet, you throw it away, but we ask you to replace, like maybe the returns from 20 of these stocks that ask you to dispose, you can put it in the index. And the thing is, you will probably earn higher returns at a lower cost. So if you're keen on it, you can actually email my colleague at david.chow@azurecapital.com.sg, or I believe that Sias is going to send out a mailer, and then you can also like go through Sias. Again, I like to stress is for accredited investors only. It is a community service. It is by no means business for us. It is something that is a little bit of outreach, and we are very happy to be able to serve the Sias members in this way. And if you want to do a little bit of follow-up, you can actually like follow me on my Facebook. You can just type Terence Wong Azure Capital. I'll have some updates on the people that I meet and some of the media interviews that I've done. But recently, obviously, I've not met many people given the current restrictions. But I believe that in the next couple of months, as the restrictions get lifted, you know, I'll be out and about, and I'll be giving you the up close and personal views of some of the key management, the movers and shakers of Singapore Inc. And another way is you can actually please pop into our website. David and I, we have spent quite a fair bit of time together with the designer and the marketing agent to put this thing together. It's just been revamped just in time for this webinar. With that, thank you. I will take on the questions. I'm going to go to another screen because that's where the Facebook Live is right now. And I'll try to look at the questions that you have. Okay. Okay, I'm going to bring it closer to me so that I can see better. Okay, what do you think of CLI when it is listed? Potential to be new global REIM? Absolutely. I think that it is. I think the CLI is going to be interesting. As I mentioned earlier on, if you look at the other contemporaries, the real estate investment managers, the REIM, they're all trading about 2 times book value. Currently, if you were to break up everything, get back your dividend, get back the shares in specie, all in is going to add up to about 410 cents, and that's pricing it at 1 time book. I think that there's still going to be upside. And CapitaLand, the development part, they will warehouse Temasek, and CapitaLand will actually warehouse the development projects. And once it becomes accretive, it can be pumped into one of the REITs. And so I think that this arrangement is the best of all worlds. I do like, I mean, amongst all the major shakeup in recent times, I think that this one makes the most sense, and I do appreciate that. Hi, Terence. Could you share how much side cash you park for your fund now? How much upside potential for STF for the remainder of the year? I think I still do have some cash, perhaps maybe about 15-20%. I do expect some form of volatility in the near term. I've been thinking about that even before this crazy sell down in China, Hong Kong. And I think that there could be good opportunities in the near term. How do I expect? Like I said, for volatile market, how do I expect it to end? I believe it'll go lower before it come out higher, and I'm not surprised if we actually surpass current levels, except that your entry point, you may be able to get it at a considerably lower level. Singapore tech stock, Mr. TC asks, Singapore tech stocks, UMS, AEM, Aztec, Franken, which you think is better to invest? Tuffy, I think that this rising tide will actually lift all boats, but again, with the volatility, many of them will get hit. So it really depends on who gets hit more at this juncture. Some of them do have potential. Aztec is coming up with its results. It's first off the block. I think it's his first major results. It seems excited to come out with it fairly quickly. So I hope it is better than expected. I don't own any shares. I hope it's better than expected. A lot of people are banking on they call it customer A, like one of the largest tech companies in the world. I mean, leave it to your imagination. Which company starts with letter A? It accounts for 60% of its total revenue. I believe that IoT business will continue to grow. Aztec have popped up before its IPO, I think sold down by some of its early investors. So right now it has dipped below its IPO price as of yesterday. I think that's one that you can possibly look at in the short term, but companies like UMS, AEM, Aztec, all of them would be hit with I think supply constraints, and that is true for many other tech companies. Franken, I think it's a little the impact is not as great, given that it's in mechatronics, so they don't really bank on that, right? The key components, the semicon and all, because they are into mechatronics. They are one of the critical and possibly the sole supplier to many of the non-core parts. But the semicon shortage will actually hit it if the end customer, as an entire product, they slow down production. And so Franken will also have to suffer, as a result. It's second degree, but then it's not as direct as the likes of, say, AEM or UMS, right? But then it will feel the impact subsequently. So I think that Franken will be the furthest away from the pain by the supply side. See more. I'm reading a question by Mr. Kim Ming. Due to Chinese regulations, those who are fearful will have to sell off by now. So it's a good time to move in and buy the dip. This is considering purpose of Chinese regulators is to provide healthy growth in the future instead of killing the Chinese big tech. I do think so, but that's conventional thinking. It's just like, in Singapore, we always say that the government is there to cool the industry and not to kill it, right? That's Singapore and maybe a good part of the rest of the world. But in China, I think it's a different story, right? So I would like to think that there's some sanity will return, and like I said, many investors are already invested there. Many of these retail investors, they will feel the hurt. And I believe that, the Chinese government would have to one day try to at least, alleviate the kind of pain that's being felt by the retail investors. No doubt that it will one day jump out. It's just that I don't know when. So I can't make a call because you're really betting on the regulators. It is no longer a matter of fundamentals. I mean, it's fundamentals. I just take the numbers here. I look at the plans for the group. I can really tell, that's cheap, and many of them are cheap right now. That's without a doubt. Especially if you compare against the global rivals, right? And you have China. China, you have such a major market. In fact, it's so big, but yet it's so fast growing, right? Definitely, there will be takers, and I believe that once the dust settles, the retail guys will be there. The insti from overseas will also pile in, because there's no way they can invest in some big tech companies now in the US, right? They have to invest in China some way, somehow, or via the Hong Kong market. So there will be a time where I believe the markets will come back, or the China Hong Kong markets will come back very, very strongly. I didn't check today. Maybe it's today, right? But like I said, it's gonna take a bet. Maybe if you do have a long-term horizon, then yes, I mean, you can buy at every level. It's just like last year in March, when the markets were plummeting, you can buy in at different levels, and then when it starts to turn up, you will look like a genius, right? When it starts to turn up. But then if you ask me if you want to park everything there, and my question is, would you be able to tolerate, can you tahan a drop of another 10-15% in the short term, right? I do know that investors, after TT listed in the US, $12 to $15, right? When it went down to $11, they started to pile in. But right now, they are caught, right? They're down 40-50% in a very, very short period of time. So will you be able to tolerate this violent movement? Maybe in a year's time, the share price will move up many times over this. But first, you have to take the short-term pain. Okay. Hang on, let me just open up the comments. What is the view of the semiconductor sector? Any recommended stock in this sector? I've answered that. I do have a few on the list, though you have to be very, very careful about what's going to be happening right now on a global basis. The China-Hong Kong market may have some repercussions in the local market. And so this is a standard line across all the different stocks that we're talking about. They may have strong fundamentals, but near term, there could be some jitters, and you may want to find a certain point where you feel comfortable to go in. I see questions, but I'm just trying to open it up. Jim, Wilmer has dropped by about $1 from the peak when results and forecasts are good. Any reason? I've not looked very deeply into Wilmer. Possibly worth a read. I mean, if you've got anything, you can just give me. I mean, you can pop me a email. I can follow up on that. That's something that was on my list, but I never really got down to looking at it. Are you still bullish on Yongnam given its current woes? Yeah, Yongnam has been a big disappointment, I've got to say. And we were banking on the big mega projects that will propel it. Changi Airport T5 being one of the big ones, the North-South Expressway. Even in North-South, there were some delays in the works. T5, you can see it. The ministers have been reporting and saying that, it's a terrible time. They are already pushing back so as to support the budget. That have one of the big casualties was Yongnam. I have to apologize because some of the comments that you guys made, it's been pushed down. So as I'm talking, and I cannot expand on it. I'm just wondering whether I can. But I'll answer whatever I see right now. How much banking sector in percentage of portfolio, and how much percentage you recommend for us to allocate? I do have I mean, I'm not I don't look at the composition of the STI and compare against it, because mine is more a regional portfolio. But if you were to think about an allocation into the banking sector and you want to just mimic you want to just mimic the STI, then we're talking about 30-40%. I see some of the investors that sent over a portfolio, they do have a very, very large financial institutions exposure. Some don't have it all, but then there are some that are fairly large. You can think about whether you want to try to beat the STI. You think that if the banks are going to be your passport to doing so, you can actually increase it beyond what's the STI rates. But like I said, I feel that while the banks are not expensive, and the yields are still decent, but it has run up quite considerably. So to build something right now, probably you instead of like already invested, say at the start of the year or last year, right? You probably want to take your time to build it. You don't need to have that kind of exposure, like to mimic the STI at this juncture. iFast has been a darling of the market, definitely. P 80 times. Yeah. Does this justify for potential growth it has for the next few years? iFast is a tough one. I mean, it's gone up tremendously. You look at the numbers, it is impressive, right? But to pay 80 times for it, if you read the Business Times over the last few days when iFast came out with the results, one of the investors, Steven, a friend of mine, he's also from SIAS. I think he commented that he knows that the valuation is expensive. If you are a value investor, you think that it is kind of expensive, right? And even Chang Chun, the CEO founder of iFast, him being an analyst from before, his last quote was that, I understand, that it may not seem cheap, right? But then this is how investors this is how investors assess it, and we've got to respect the market. But for me, I look at iFast, I think the numbers are high, right? At 80 times, seeing great growth, but yet the numbers still very, very high at this point in time. Got to be cautious. Chen Tian, hi. ISDN looks bullish turning around. Yeah, I read an article on ISDN. It's one of the Novo Teller stocks. Seen tremendous jump after their investment in it. They're talking about moving into this super Wi-Fi business. I really don't know how to access it. I'm not too sure about the valuations, but it has definitely done very, very well. What is your opinion on fintech companies? David Low asked this question on fintech companies. I said, fintech companies, you have to be very, very careful. Obviously, the propensity to there's like a lot of hot money in it right now. If you look at the collection of unicorns out there, I believe a good portion, they just did a study, a good number of it are unicorns. A good number of the unicorns are actually from the fintech space. But a lot of people want to be in the fintech space. It is going to be increasingly crowded. You got to look for one that I believe, like I mentioned earlier on in the slide, you got to address one of the major pain points, and you got to be able to scale very, 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 very quickly. Because if you've got a good idea and you cannot scale it on your own or with some help, then somebody's going to take over the idea. So take ownership of the idea. And I feel that is something that you need to be very, very cognizant of when you want to invest in fintechs. What do you think of undervalued stocks like Tuan Sing and Hong Fook? These guys have been undervalued for a long time. I know Tuan Sing well. The portfolio is definitely something that's very, very, very valuable to them. If you look at they saw Robinson Point, and some of the residential properties are also selling off. Well, I believe that the management is now moving and looking more at commercial rather than residential, as with a lot of the small mid-cap property developers, because they they feel that, you know, it can be very, very onerous. Of course, there's a massive, huge rush on property company on properties right now. If you look at what happened with Pasir Ris, 8 Pasir Ris, selling at close to $2,000 per square foot. It is an integrated project. Admittedly, it is a great project. It is well sited. It is within, it's like say integrated city. But to pay $2,000 for Pasir Ris, a 99-year property in Pasir Ris, well, I think that this is crazy, right? And they basically have multiple upgrades of the price or increase in the price over that one day when they're bidding. 80% of it has been sold. I at an average of 1,006. As I mentioned, the max went was $2,000 per square foot. This was not too long ago Orchard Road prices, but yet we are paying this kind of levels right now. So I think that as what I mentioned about property prices is because this will have implications for the likes of Tuan Seng, the likes of Home For, like you mentioned, it is very, very undervalued. They could potentially take it private, like many others, or attempt to take it private just to sort of like cement the real value, the true value of the company, right? Because right now it's trading at a huge discount, again 60-70% par for course for property companies. Should we hold on to CapitaLand shares or take full advantage of restructuring, or should we sell some to take profit since the price is good now? Long term, I think that price, if you break it up, the price will be better. But in the short term, you know, with all the exercise going through and some uncertainty in the market, that could be a casualty too. So wouldn't be wrong either way. I mean, you have really like benefited, assuming that you came in before the announcement, you have really benefited so much. You may take some off the table, but I believe that in the long term, this is the right move. Like I mentioned earlier on, amongst all the shakeups in recent times, the CapitaLand one would make the most sense. And I believe that this may set a precedent for the rest of the property companies to think about actually listing their real estate investment manager. Nanofilm, Jim, very busy today. What's your view of potential growth of its business? Again, I haven't seen it since its IPO. So, you know, other the fact that, you know, they just bought this sprawling GCP, the founder's wife. I've not seen them recently or read about the business, but I will find out. So Jimmy, you just like email me or you just WhatsApp me these two counters. I'll try to follow up. I see Miso Leong, do you think capital infrastructure will be disrupted in the future? I don't really know what's in capital infrastructure at the moment, but I do, because I've not taken a close look at that. But in terms of disruption, I can definitely like find out more on this. Yeah, to apologize. The rest of the questions I cannot see. If you do have any questions that I've not addressed, you can just pop it up again. You can just bump it up again. Okay, I see some of the questions coming through. Bukit Sembawang, it is the biggest landed property owner. It's been around for forever. Lots of legacy land, and I think that with this pickup in landed property, you can see a lot of the landed property being scooped out. I'm quite sure that they will come in to be a lot more, slightly more aggressive than what it has been. It's a very, very sleepy company, but I think that it'll be more aggressive, like pushing out the land parcels, and I think that this can be a positive for the company. Yangzijiang, currently it has been getting a lot of the orders, right? I can see insiders buying. That lends credibility, that lends confidence in the company. It is currently trading. I mean, it has gone up to around 40. I think it's given up some gains. I don't know whether it's because of China, the China issue, but currently the company is still trading at between, even after that big jump, it's still trading at between 7 and 9 times. It does have some cash. It is the largest shipyard in China that's listed in Singapore. So it's definitely worth a look, especially with this pickup in oil prices. In the past, it used to be plagued by the fact that there has been a lot of the cash has been used for shadow lending, right? I believe that they have cleaned it up. Sirius System was in the limelight recently due to increased revenue. Do you think it's sustainable when its business model has not changed? Yeah, it has bobbed up, and it has given positive guidance. Last few years, I think, and I think Derek Ko, the founder, has also mentioned, it's gone into many different businesses. They seem to be a distributor for everything, including durians, but they have to write that down, right? Right now, there's a big focus on its core business. That has improved dramatically, but it may seem like a one-trick pony because, when things go the other direction, it also will be whacked. Distributors are not my favorite. I mean, like, they get razor thin margins, and a little bit can actually like shift it from black to red. So I used to cover the distributors, and I think that it is a very tough business. You can have multi-billion-dollar revenue, but yet your profits pittance, few $1,000,000 here, few $1,000,000 there, right? And it is, like I said, a little bit of it can actually shift the dynamics of the company. Like the last time when they lost Texas Instrument for Sirius System, that the company did take a big hit. APAC Realty versus Propnex. Propnex have been on the tear. I mean, like, okay, both agencies, to be fair, have done very well, but Propnex, well, if you look at the earnings and all, I believe they've taken market share away from APAC Realty. But I mean, I was a cornerstone investor in APAC Realty, so I do know them very well, and I think that the income or the current CEO, Marcus was the CEO before, he does have many good plans, I think, to actually like pull or to increase the workforce and make them a lot more productive. But agency business have done very well. I mean, you look at the numbers, and it's done even better in terms of share prices. Xingxiong and their growth in China and Singapore. Xingxiong, I think that it obviously, in terms of valuation, is not very cheap, but then it is a core essential business that whenever there's a problem in Singapore, you'll see it pop up. Or else remaining equal, I think that I'm just very neutral on the counter. But they have seen tremendous growth over the last couple of years, and even without, I think COVID have definitely accelerated it. But even without COVID, I think that this business have grown very nicely. The Lim brothers have done supermarket chains over in Singapore. CapitaLand again. CapitaLand now or wait after the AGM. Right, the thing is, I don't think that there is whether you sell it now or after AGM. Like I mentioned earlier on, you take a short term or long term. Short term, you have really like benefited a lot from it. You're going to take some off the table, and then because I feel that the markets are kind of jittery right now, so you can take some of the market and come in a little bit later, perhaps after the AGM. There's one comment about an interesting small cap. One that I have, one that I mean, there are many small caps out there, but if you want one that relatively safe, that can ride on the near-term boom, companies like, say, HRNet, which recently you see a few initiations, right? That I think
these are quality plays. I've always liked HRNet, even though they've not done well up until COVID. Then the last few months, they started to prop up again. The cash, they have been continuing to generate cash. I'm talking about these guys because they are safe, right? They have like $330 million of cash. That's 42% of the entire market cap. If you look at the valuations, we're only talking about 9-10 times net cash PE. So it's very, very palatable. It's well run over 20 over years. It's hardly like lost money, only lost money 1 year. 30 years, I think it's been up close to 30 years, only 1 year in 1998, it lost money. So it's a well-run, well-oiled machinery that can benefit both from the permanent and the temp workers. And it's surprisingly difficult to go into temp workers for the big organizations like the banks, the DBS, OCBC. Why? Because the banks only pay them in 2-3 months. They otang them for 2-3 months, then they pay the HR company. So HR company would have to have a very huge balance sheet to be able to supply the workers to them, because these workers are paid on a monthly basis by the HR company. TCTI, I just see interesting. 1 day to end of July. Do you think STI can reach 3190? What is STI right now? I don't even know what is STI right now. You're talking about tomorrow. Can it reach 3190? I don't know. I'm not sure about that. But I don't. This one you need a lot of crystal balling. Like I said, I'm not even sure about what's the STI level. Let me go and check what's the STI index right now. 311, day range 3119. Okay lah, if there's a rising tide, then everything will go up, right? I mean, if there's a massive increase in the US, they jump up like 1,000 or 2,000 points, I think you also will hit 3190. But short term, don't look at it, right? When you invest, you want to invest in the long term. Jimmy, glove stocks, UG, Riverstone, Top Glove, we agree that they have peaked last year and unlikely to be back until new pandemic surface. I think very, very peakish. You're right. Look at you just need to look at numbers. Even though the numbers are of these three, the numbers are palatable. I mean, this year's PE, we're still talking about what? 4-5. We're still talking about 4-5 times PE is low, right? The dividend yields are high. Riverstone is what, 7%, 8%. UG, I think, is lower at 3-4%. But with this new EMCO, what's the E? E is enforced. I don't know. They have as many MCOs as we have budgets over the last 2 years. So this new EMCO, many of these glove guys that are actually situated in Selangor, right? And they have to close it completely. Say for maybe Riverstone. Riverstone is in Taiping, right? So when they close it completely, what's going to be the implication? Demand for gloves are still going to be extremely strong. But with this closing, this will push the global demand, the people that want it, want the gloves, the customers, to move to second-rated places, but yet they can get good gloves from the likes of China, Vietnam, is it Thailand? Right, some of these places may not be as good, but then you're pushing them over there, and then once they're used to it, don't get them too used to it, because there may be a permanent shift. So this can have an impact on the Malaysian glove guys. Like I said, many of them will have to close their factories for this particular period. But in terms of Riverstone, I think because it's situated in Perak, it's 60% initially. You can only do 60% production. Now it's gone up to 80% of the production. So it's going to be less of an impact. But yet, I think many of them will still feel the shivers.
Terence, maybe we can answer the last question. Yeah.
Oh, okay, can. Okay, I'll take one last question. Okay, since it popped up last on the screen, any insights into Silver Lake Axis? Silver Lake Axis was a one-time darling. I think when we covered it many moons ago in 2013, that was really one of the peak times. Then a series of things happened in the company that revolved around the owner, and also because Silver Lake Axis is involved in banking, creating a banking platform, right? The Mobius system and all. So they had a banking platform, but many of these banks are going into digital space. So while they service, I think the top 20%, I mean the 20% of the top 20 companies in ASEAN, right? So there's like 4 or 5 of the companies, the banks including OCBC. But like I said, many of them are leapfrogging, but they are trying to, they have developed a good team, and this team has been trying to take back the business and then improving on their current architecture. I believe that the business will continue to pick up over the next few years. I don't see a monstrous growth, but then given their pedigree that they have continued to serve the banks well, it would be one of the interesting stocks to take a look at.
Okay, if you got any other questions and if they are pressing, you can always email us. We can take a look, or you can email SIAS and then they will pass on the questions to us. Okay? If not, I thank everybody. I know there's still some questions. I really have to apologize because this Facebook Live, I can't like scan and look at all the questions that you have. So whatever is on top, it gets, whatever you answer, and I unfortunately don't see it gets bumped down, right? But I'd like to thank everybody. I do hope that one day we can, do a seminar proper. We can meet each other in person. We can do, and then we can have the mingling kopi session right after that. Okay, thanks everybody. Have a great rest of the week ahead.